Hello everyone, welcome to chapter 14 on long-term liabilities. The meat of the chapter is about bonds, right? Corporations that issue bonds as well as stocks that we learned about in the last chapter. Many corporations, in addition to their common stock and preferred stock in many cases, also issue bonds. Bonds are a form of debt. They require interest payments and a big payment at the end for the face amount of the bond. And the main focus of the chapter is about bonds. Corporations issuing or selling bonds and then paying the interest payments and the principal at the end. But the beginning has a couple of other long-term liabilities that they know, and it's just a couple of pages. From 746 to 749, if you have your book open. If you're looking at your PowerPoints, it's 14.6 through 14.14. They talk about long-term notes payable and also mortgages payable. This is also applicable to us in our everyday life when we take out a car loan or a mortgage to buy a house. This is especially good. Of course, this is a corporation doing it, but we do it as private citizens also. So maybe some of you already have a car loan and you know what I mean. That interest payments that you have to make along with the principal and all of that stuff. So I'm going to get to that part first, and then we're going to go right into the bond section, which is the largest section. The chapter is not terribly long. It's a little shorter, I think, than chapter 13. But I'm giving you more time for 13 and 14 because I think there's lots of topics within these two chapters. And as I mentioned in my notice this morning, for week 5, we are ahead of the syllabus, which is a good thing. So I'm slowing it down a little bit. So we'll have 2 weeks, and I'll be giving you your outline for the next test on Friday the 16th. And the test will be available starting on the 19th on these two chapters. So we have 2 full weeks to kind of catch up and finish up. Ask me any questions you want. Okay, I got that part out of the way. So let's take a look at this. The first thing on 746, they show you a note, right? A long-term note. We had short-term notes payable in chapter 11 in 101, so we kind of just finished it. If you just took 101 with me in the summer or with another professor, you might recall those who were doing 1 year or less. These are greater than a year. And it's pretty self-explanatory. Smart Touch takes out a $20,000 note, and it'll be paid in 4 years. Yep, 4 year, 6% note. And just like assuming from a bank, right? And we saw some of those short-term notes again in chapter 11. And what they show you for the long-term notes payable on the next page is an amortization schedule. That's just a list of your principal payments and your interest payments. This one's a fixed payment of $5,000, and then the interest expense, and then the total payment. Interest is always higher at the beginning part of the loan because you're paying that 6% on the unpaid balance, which is why as your unpaid balance comes down, so does your interest. So by the time you get to the end, right, you're paying a much smaller amount of interest because your principal gets lower. And it shows you all 4 payments. And again, they're fixed at $5,000. Most people like the fixed payments because they know what to expect. That's the most common type of a long-term note. And if you've ever had a car loan, you know what I mean. Okay, those are usually 5 years, 60 payments, and they give you the schedule, and it looks kind of scary because it is. You see all 60 payments, but what you would notice is the amount that goes to your principal keeps going up, and the amount that goes to your interest expense keeps coming down. And the reason for that is the fixed amount of interest that they tell you you're going to pay is applied to what you owe. So as the part you owe goes down, so do the interest payments. So it shows you the interest expense in the first year when it was $1,200, highest of all. That's on the bottom of 747. They also show a second example, which I won't go over, but it's on the next page. Oh yeah, I'll mention it. It's a building because it's a mortgage. It's a little bit different. The mortgage usually is for a longer period of time. I just thought this was another example of the long-term note. It is a long-term note, but it's a mortgage. Mortgage is usually for 30 years. So this one, Smart Touch bought a building. They put $49,925 down in cash, which is an odd amount. And then they financed the rest with a mortgage for $100,075. And what they show you, at least for the first year with the monthly payments, the principal and then the beginning balance for each, and the principal payments, you can see the principal payment, the lowest, it's only $99.62 in the first month. And you can see it keep going up. That moves in a upward direction. And the interest expense comes down every payment. Again, it's being applied to the unpaid balance. And then it shows when you've finished the year. Your interest expense in the first year was almost $6,000, okay? And that's a percentage of 6%, right? Fixed percentage amount. So the total payment, again, is $600, but the split between interest and principal changes. And they show you the journal entry for that on the top of 749. And that's all they really say about the other long-term notes that they mention, the regular notes payable and the mortgage. They get right into the bonds, starting at the bottom of 749, all the way up to, did I put it? Hold on. 748 to 751 gives you some terminology and background on bonds and types of bonds. Let me catch up with my slides. And that is slide 16 through 20 gives you some of the terminology that they're going to be talking about in relation to bonds. They even show you the picture of Smart Touch's bond. That's 1419. And I think it's on the next page, 752, if I'm not mistaken. No, I'm wrong. Here's the picture of the bond. It's on 750 at the bottom. What I wanted to call your attention to also, before I get into some of the terms, what I really like is this timeline on 750. If I can find the slide. I found the picture. Here we go. The slide is number 18. A bond is always two streams of money, at least a bond that pays interest. You may have heard of a bond in relation to a government bond, a U.S. government bond, that sometimes somebody will give you for a gift when you're a child. Okay, and in 10 years you get double the money usually, or sometimes even more. Like you could buy someone that's born or that's having a birthday, that's a child or graduating from 8th grade or high school or even college for less than half the price of what it would be worth in 10 years. The difference between a government bond and a corporate bond is government bonds don't pay interest payments to you periodically. But the interest is inherent, which means it's in the bond, and that's why you get so much more money at the end of the term. In other words, if you got a $100 savings bond, someone probably paid $50 or less for it, depending on what the market was doing that day. They're sold at a very deep discount, much lower than the principal amount. And this is because they don't pay interest. Often they're nicknamed a zero coupon bond because there's no payments. But that's not the kind we're going to be talking about. We're going to be talking about corporation bonds, which do pay periodic interest. Semi-annual is the most common, twice a year. Okay? And I love the timeline they have, as I mentioned, number 18, or on page 750 if you're just looking at your book. It shows you Smart Touch's bond. It's a $100,000 bond that they sold January 1, 2018. It's going to mature on the 31st of December 2022. Okay? It's a 9% bond for 5 years. You always have to double the years because 5 times 2, there's going to be 10 periodic payments. And what I mean about the 2 streams of money that the bondholder is going to receive, every 6 months they're going to get whatever the corporation states call the stated rate or the coupon rate. There's actually 2 more names for it too, which I'll get to in a minute. But they like to call it the stated rate in this book. In the book we used before, it was called the coupon rate. It's whatever rate the corporation says they're going to give you. But they state it in an annual percentage. So when you're doing the interest, you have to cut it in half for 6 months. So because they're stating 9%, that's $9,000 a year in interest payments, but they're going to do it twice a year, cut it in half, 4.5%, right? Each 6 months. You can see the $4,500 payments down at the bottom. There's going to be 10 of those. That means $45,000 in interest they have to pay their bondholders over that 5-year term. Plus, the second stream of money, at maturity date, they have to give them the whole face amount of the bond, $100,000. So being a bondholder is pretty good. Okay? Why would the corporation choose to do this rather than selling shares of stock, which you just have to pay dividends on? And if you don't make a net income, you're probably not going to pay the dividends. You don't have to do it. Plus, your shareholders probably will revolt if you don't do it twice in a row and sell your stock and go somewhere else. However, with bonds, you can't miss. It's a bill. It's a payable. You have to pay it. So it's much riskier. This is called debt financing, and stock is called equity financing. And those 2 forms of financing, the balance of them is what corporations struggle with, because the #1 goal is to increase the wealth of the owners, the shareholders, no matter how many there are. And believe it or not, when you get a good blend of stock and bonds, that blend increases the wealth better than just the stock alone. And I'll show you an example that shows that in just a minute. And it works every time. It doesn't only work in this one. It works in every, well, the old book, I used to like it. It had a scenario of 3 different things. This only has 2. But that's okay. It still serves the point. So I'm going to show you that in a minute. So I want to show you a little bit, is that picture. Why they have a picture in there, I'm not quite sure. But there's some terms on page 751. And the types of bonds, you can read about that yourself. It's not a big deal. Between term that all mature at the specific time, okay, and serials, which are interval bonds that mature at different times, which is better for the corporation, and then secured and unsecured, sometimes called junk bonds. You might have heard of that term. They have no collateral based behind it, so they're usually cheap, but they're rated below B on the stock exchange. Anyway, what the real part I wanted to get to, and kind of the next whole phase after I talk about the plans between stock and bonds that I want to bring your attention to, you're going to see it all the time. Face value. If you sell a bond at face value, that means its selling price is going to be the same as the face amount or the principal. How could that possibly be? Well, if you're offering, your stated rate is the same as what everybody else in the marketplace is doing, it's going to sell for 100% of face. The easiest possible of all scenarios, you don't have to worry about what to do with the discount or what to do with the premium. But does that ever really happen? Well, there's one example of that in the book. But in real life, it does never happen. Actually, I've never seen it. Because generally speaking, the corporation in reality, we'll sell bonds at a discount. It's very difficult to sell it at a premium. When you sell it at a premium, which is above face value, people are going to pay more because they're getting a higher interest rate than they can get on the marketplace. Can you afford to do that? Maybe you can. So maybe you want all the money now. You need the money for some kind of expansion. And you say, I got plenty of reserve for those interest payments, we're good. Well, then you might offer more. But the discount is the most widely used way that corporations sell bonds. And what that means is you're offering less than the market rate. Okay? We always compare the stated rate the company offers versus the market rate. Those terms I was talking about that kind of have, I was hoping, I think I went past it. Just so you know, going back to slides 16 and 17, the face value, and they like to call the principal the face value, maturity value, principal value, principal amount, or par value. I've never heard it called that, never, but they have it in here. And then for the rate the company would offer, they like to call it the stated rate. I was very used to the coupon rate. That's the way I learned it. They have nominal and face rate. I've never heard of either one of those. But they are in there, so I wanted to mention. Okay, back to this. So before we get to issuing bonds, issuing meaning selling, that was a very good question someone asked me. When we talk about issuing stocks or bonds, we talk about selling them and debiting cash from the money that we got and crediting the stock account. In this case, we're going to be crediting bonds payable. Okay, but just words are very confusing in accounting, especially. So before I go into the plan A and B, or 1 and 2 they call it, to kind of prove my point, it isn't my point, it's just a fact, that the blend of the sale of stocks and bonds will increase the wealth of the shareholders better than just one. And I'm going to talk about that in 1 second, and then we're going to get into some of the problems. In video 2 and 3, I do an example of a bond selling at a discount and a bond selling at a premium, so you can kind of get a feeling for both. But before I get into that, it's so funny the way they do this. They have one, I would say, one big paragraph and one that's like 2 sentences about kind of an important topic that they really don't, I won't give you too much history about this because it will take too long. But it's called the present and future value, or the time value of money. This is introduced in a very small little way here, okay? They do have a whole area after the chapter, Appendix 14A, that shows you time value of money problems. And they have you solving them, which, again, we don't have to be responsible for anything in the appendix. But how they solve them is by looking in the appendix in the book, all the way in the back of the book, the tables, present value tables and future value tables, to get what's called the interest factor. It's a 4-decimal number, right? Or a whole number with 4 decimals. And that's a good way to solve the problem. And it used to be in the chapter up until several years ago. We had to price our own bonds. We had to get the present value of the payments and add it to the present value of the lump sum, the principal. Physically do it, mathematically, make the formula, add it together, and come up with the present value. Matter of fact, in tests, I had to photocopy the tables and hand them out. Okay, that's how much we needed them. No more. They stopped that and they put it in the appendix. And now they just tell you what the bond sells for. Very convenient. Except if you take a finance class, you're definitely, and you probably need to, even at BCC, you need a corporate finance class, you're going to see this topic again. So I wanted to mention what it is. I don't think you find out too much from reading those 2 paragraphs, except if you just put money in a drawer and you look at it in 5 years, it's the same money, right? If it's $1,000 and you got $1,000 there in 5 years, but it's now worth the same thing because prices have gone up. You could take that money and invest it, and it would be, hopefully if you choose your investment wisely, it would be worth more. This is what the time value of money is all about. Okay? And there are 3 ways to get the problem, solve the problem, as I mentioned. You can go through this even worse than the tables. There's formulas to get the present value interest factor and future value interest factor. They're awful, not fun, but it probably takes you between the 2 formulas, maybe 10 minutes or so once you get used to it. If you look them up in the back of the book, probably you're down to 2 to 3 minutes. So we're improving. However, there's a much better way, and it's the handy dandy financial calculator. I'm going to show you, and I know we don't need this right now if it goes on. I'm going to show you, I know you're not going to see this too well, but I'm going to put it up on the board. Smart Touch's problem. It's on 7. Let's go ahead for a second and go to 756 and 757. Well, 756 for now. This bond that they're going to show us, a $100,000 bond, is selling at a discount. And they're only going to get $96,149 for it. And the difference is the discount of $35.81. And to get that, I mean, they just told it to you. But we could have looked in the back of the book and got the factors for the $100,000 and the $4,500 payments and added them together, and it wouldn't have been that bad. But check this out. If you have these, they cost about 20 bucks. I have a Texas Instrument BA2 Plus. Had it for years. It's awesome. It does everything. Say we had this problem to do and you were in finance class. I teach finance as well, so. Okay. So let's say we're going to put our variables in. So this is a 5-year bond. So we have 10 payments. So the number of payments, N stands for number of payments, is 10. I stands for the interest rate. We don't want the stated rate. We only use that for the interest payments. We use it for this. 100,000 times half of 9 is 4.5% or 4.5, and it's $4,500. These are the interest payments. And we know there's going to be 10 interest payments in each scenario of this problem. 9% per year, 4.5 every 6 months. But we want to know what the market rate. You always use the market rate either for formula lookups or to do this. You only use the stated rate to get the interest payments. Matter of fact, in finance, we have a garbage can PowerPoint with throwing the coupon rate or stated rate in the garbage can. It's kind of funny. But that's the point. Once you're done, you're done. You don't use it for any of the formulas or to put in the financial calculator. So we have, excuse me, let's see what the market is. I think the market is 10. If I could just find it. Top 10%. Okay, so I equals 10. Okay, the payment is going to be $4,500, and the future value, FV, is $100,000. And I want to know what PV is. What's it selling for? What's the present value? Future value, FV, present value, PV. This is shaken because I didn't tape it for that, so don't mind me. So we have all of our variables. If we put them in the calculator, now you can't really see this now, but You just have to check out how fast it is. So I'm going to go 10 is N, right? If I put it on, it would be easier. 10 is N. 10 is interest, right? 4,500 is the payment, and there's all little buttons on the second row of the calculator. And then the future value is $100,000, and you put FV. And then there's a little compute button, which is in the top corner. And then you hit present value, PV, I want to make sure I see it. And you get the same 96,000, I got 96,148 and change, because it's exactly right. What the calculator does is have, like, I've got like decimal points all the way to infinity. So it's going to give you the exact amount that it sells for. This does rounding because the numbers in the back of the book only have 4 places, okay? So the present value is 96,149. And it takes seconds to do it. Same thing if you needed the future value. You would make this, as long as you have the other variables, you can find out any variable you want. And this is going to be very helpful when you take financing of any type. Personal too. That's another thing that they have at BCC, personal financing. Okay, I just wanted to take a minute for that, and I know you don't need it right now, but okay, before we take a quick look at the examples, again, I'm not going to dwell on the examples because I do them in the next 2 videos. But what I wanted to point out was on 754, slide number 27, is the plan A and B. So you have to go back a little bit. It's at the top of 754. So you could do a bunch of these, and in my student teaching years, I've done a bunch of these. It's issuing bonds payable versus issuing common stock. Okay, and again, there's only two plans. The more they have, the better you can see it. But this one, they need, here's the thing. Smart Touch believes, okay, they can borrow, plan 1 is they can borrow $500,000 at 10%, right? In other words, issue or sell $500,000 of 10% bonds payable, right? And they'll get the $500,000. Or they could issue 50,000 shares of common stock for $500,000. Now, what would be even better is if they had plan 3 with the mix of both. That would be the best. That would be your best scenario. They don't show that. What they want to show, though, it's effective in showing what we need to see. So if you look here on plan 1, we get the net income before the project, $300,000 on both. And then we have the interest expense for the bonds payable, right? We're expecting to get $200,000 new income from this expansion. And it's going to cost us $50,000 interest payments. That looks bad, right? So you're only netting $150,000 from that extra $200,000, and you say, oh boy, I don't want that, but you have to give it a little more time. Income tax expense is $20,000 cheaper because you're paying income tax on net income, right? On income from operations, I should say, before the tax. So here's the net income, and it's still a big difference. It's only $90,000 from the bonds because of the interest expense, and $120,000 from the stocks. And you say, well, there you go. It's better to do stocks, but it's not. Because what happens when you sell the stocks instead of the bonds is you're diluting the shares. But by that mean you're watering them down by having more circulate into the public. So when you get earnings per share, which is net income minus preferred dividends over the number of shares outstanding, comes up later, you're going to have more shares outstanding, so it's going to make it denominator heavy. For instance, plan 1 net income is only $390,000, but we're only dividing by the original 100,000 shares outstanding. So the EPS, or earnings per every share, is $3.90. But look what happens if we use just stock instead. Now we had to sell another 50,000 shares of stock to get that $500,000. Didn't do any bonds. So now we made $420 in net income, which is better, right? It's a better numerator. It's a higher numerator than with the bonds, but the denominator was up to 150,000 shares outstanding. You just added 50,000 more in there. So your earnings per share is only $2.80. It has a huge effect. And again, the best thing would be is if they showed us number 3. There's no number 3. But if they blend it in the right way, it's nice. I mean, we used to do in grad school about 10 scenarios until we got the right blend. That was many projects, believe me. But you got the right blend to make the earnings per share the highest you possibly could make it. So this is just a little taste of it. It's the beginning. So it's pretty interesting, I think. Of course, I think accounting's interesting. Call me crazy. Anyway, what I wanted to mention, and we're going to see this in the next 2 videos, from pages 755 to 60 and slides 29 to 43, you're going to see bonds selling at face amount, right? Market rate versus stated rate, same. Bonds selling at a discount, market rate is higher than what the corporation's going to pay, so it sells at a discount, again, the most common. Or stated rate is better than market rate, it's going to sell at a premium. You're going to get more for it, okay? But you have to pay higher interest. So instead of me going over every single one, you can just read this over. And again, the next 2 videos are examples of these. They also show the amortization of the discount, and by amortization, it's straight line the total amount of the discount over the number of payments, and for each of these it's 10 because it's a 5-year bond. In other words, the discount was amortized, let me go back to the discount. So for 96,149, so that made a discount of 38.51, and that was amortized over 10 years. So every time was at 385. They round it, they don't do the 10 cents. $385 amortization of the discount. The premium one on 758 and 9, it sold at 104, so 104% of face. They got 104,100. 4,100 was the difference between the face and what they got. So they amortized the premium over 10 years, 410 each amortization. And the reason I'm not spending more time is though that's what's in the next 2 videos. Okay. They have the callable bonds. You can either keep a bond until maturity, which is the easiest to do accounting-wise. You come to the end of the term, you just pay off the bond. Debit bonds payable, credit cash for the face amount. You're done. Everything's been discount or premium, whatever the case may be, has been totally amortized. But, of course, that's not what always happens. Sometimes you can have a gain or a loss by calling it in sooner. If you have a callable bond, that favors the corporation. You can buy it back on the market when it's good for you to do it and you're tired of the interest payments. And maybe you can even have a gain on it. And they do show that on 762. If I can just get the slides, that'll be helpful. Okay. Here it is. It's 761 first. If you do, they show Smart Touch had a chance to buy the bonds back at 95% and on the open market. And what you do, almost like when you're selling a plant asset, you compare what you're going to get for it versus the book value. Here we're comparing what we're going to pay to buy the bond back versus what we're carrying it's called the carrying amount. What we're carrying the bond for, what is that? That's the bond minus any unamortized discount, anything that hasn't been amortized. Or if it's a premium, you have to add that in. So it's a lot harder to make money on a bond callback with a premium. It's really tough. With a discount, you can do it. And this one that Smart Touch bought back at 95, they did make a gain. And this is how they did it. The face value was $100,000. The discount was down to $3,081 that hadn't been amortized. And let's see, how many? Okay, January, December. Okay, this is at the end of 1 year. So it had 2 amortizations of the discount. So the carrying amount of the bonds is down to $96,919, and we can buy it back for $95,000, being Smart Touch. So there's a gain on that redemption of the bonds. They're calling it retirement of the bonds. Same thing, redemption, retirement. The words mean the same. They're calling it retirement, so I should use it. But they got the bond back. They actually had a gain because they paid less than they were carrying it for, right? The face minus the unamortized discount. So it was very good for them to do this, okay? Maybe if they're going to go sell bonds again, you know, they'll do better. The price will be higher. So strike while the iron is hot, they're thinking. And this happens a lot. Happens a lot with you can only do it with callable bonds. You can't do it with a full-term bond. So I wanted to mention that. You can see it posted to the T accounts on the next page, 762. There's a little how-to. You don't have to worry about number 1 because we don't do partial payment and interest. That's when you have to count the days. That's a little more difficult. That's for the more advanced courses where you have to split it up into days and kind of prorate it. It's not for this level. Not that we're at the second level, but still we don't have to do that. We do have to figure a gain or a loss, and then we have to retire the bonds. Recording any gain or loss. We see the liability section of the balance sheet and how the bonds are listed. Bonds payable, less the discount, and the carrying value, $96,919. This is at the end of the first year of the bond. The last thing is the ratio. Very easy. It's debt to equity. It's only total liabilities, both short and long term, over total equity. Okay. It shows you what you have, like the split. How you divided your liabilities, such as your long-term payables, right? Plus your other liabilities and your total amount of equity. So this, Kohl's has 1.39. You might think that's high, it's more than 100%, but it's quite common for retail. It's quite common in a lot of businesses to have a high debt to equity, but the higher it is, the riskier it is. Okay, I think they say, Kohl's debt to equity for both years indicates the company has taken advantage of leverage. What financial leverage means is you make more from debt. You make more from bonds than you do from stocks, just like Plan 1 and Plan 2. You're using your debt to create wealth for shareholders. That's it. I'm all done with this video. The next 2 are very short, I promise. See you soon.